Greetings. I hope that you are all finding today's forum as informative and interesting as I am. I'm Karishma Page, and I co-lead the public policy and law practice at the law firm K&L Gates. I'm delighted to be here with you today with Stacey Cunningham, the president of the NYSE Group. President Cunningham is the 67th president of the NYSE Group, which includes the New York Stock Exchange, the world's largest stock exchange. She made history in 2018 when she was named as the first female president of the NYSE in its 226-year history at that point. Prior to her current role, President Cunningham was NYSE Chief Operating Officer, where she led the development and launch of the world's most sophisticated exchange technology platform, NYSE Pillar. Prior to serving as COO, President Cunningham held senior positions at the NYSE and at NASDAQ, and she started her career on the NYSE trading floor, where she served as a specialist. President Cunningham, thank you so much for being with us today.
Thank you. Thanks for having me.
So, President Cunningham, let's start there.
Oh, it's just Stacey. Let's start with that.
Stacey. Well, let's start there. Take us through your journey from the trading floor to now the NYSE Group president.
My journey was not at all planned out. So I started on the trading floor at the New York Stock Exchange by happenstance. I was studying engineering in school and thought I would go into a math and science related industry, and ended up with an internship on the trading floor and fell in love with the floor right away. I knew as soon as I got there that that's what I wanted to do with my career. And I had no idea that I had an interest in finance until I was exposed to it and saw it. So I spent 10 years, I finished my degree and then came back and worked on the trading floor as a specialist, or what's now known as a designated market maker, and spent about 10 years on the floor as a trader. And then I left in 2005, went out, did a few other things. I spent a few years over at NASDAQ, and I came back to work for the exchange itself. So instead of working for a trading firm, I was then employed by the exchange. And 10 days later, it got announced that the exchange was being acquired, which was an interesting time. I really had wished that somebody would have given me a bit of a heads up before I quit my job, but it all worked out well. So it was a really interesting time to be at the NYSE because we were at such a pivotal moment in really redefining how we thought about the services that we provided to our customers and our role and all the different elements of what we were doing. And so I became the chief operating officer and took my role as president just over 3 years ago. Given the context of this forum, I think there are a couple of elements around diversity that are worth including. When I started on the trading floor, while I knew that women were certainly outnumbered on the floor and I could tell that it was not an equally diverse environment, I didn't even think about my gender. It didn't even occur to me that I could or couldn't work in this environment, work on the trading floor, that it would ever be closed off to me as a woman. And I think that's a really important message because as we think about diversity, all of the changes that we're making, whether we're using our investment tools to encourage behavior change, our roles in companies as executive leaders, or frankly, just showing up to work and showing our colleagues how to approach their jobs, all of that is changing the future. And it's because other women had broken down those barriers that I didn't even have to think about it. And so I went through most of my career not thinking about my gender I was very fortunate that I certainly didn't have the experience that many women have, but it wasn't top of mind for me as a woman in finance that I was at a disadvantage. And frankly, I felt like my gender for me in my own personal circumstance was raising my profile in such a male dominated environment that it didn't hold me back. When I took the role as president of the exchange and we were on the phone with the Wall Street Journal the night before giving them the story, my predecessor said to the reporter, well, and she'll be the first woman to lead the New York Stock Exchange. And it was when he said those words that I thought, oh, wow, I will be the first woman to lead the New York Stock Exchange. I literally didn't even think about it. So that just goes to show you how little I thought about it in my own personal career. What I found was that once I was in this role, the outreach that I received from so many women and men, boys and girls, talking about the importance of seeing female leadership really moved me in a way that I realized how important it was for others to see what could be accomplished and to know what opportunities were out there. So that's been my journey. It's been fun, but it certainly wasn't one that I had predetermined and planned out.
Thank you. Thank you so much for sharing that with us. I think it is incredible to hear about that journey and to think that at that moment in history, again, had you even though you were sort of at the eve and realizing, wow, the significance of that, but 226 years and just what a significant role model you are for young girls, women that can see you in this role, but for boys and men also to see that. So that's incredible. Thank you for sharing that with us. So now you've been with the exchange through a real significant set of transitions. And what are your priorities right now as NYSE president?
When I look at the priorities for the New York Stock Exchange, it always comes back to our mission. And our mission is to help companies raise money so they can go out and change the world. And along the way, provide opportunities for others to share in that success. And it's those two components of the importance of the capital markets and the role that we play in doing that by allowing entrepreneurs and dreamers to come here, build a business, grow and scale that business, so their products and services are available to the masses and not just the few with means, and really building an entirely new change. And I mean, there's so many examples. I'm inspired by our listed company community constantly, and perhaps no more than I have been over the past 12 to 18 months. We've looked at their reactions to the pandemic and literally taking the power of their large organizations to immediately jump into action and deliver the solutions that we needed as society across the world, right? Whether we're talking about Pfizer and Johnson and Johnson and others that have really been looking to battle COVID-19, all of those that, General Motors and Ford converted their factories into producing ventilators when there was a shortage of ventilators. I mean, literally all of these companies were not saying, well, hey, I'm not going to hit my quarterly numbers if I convert my factory line into produce ventilators. They just thought about how they could help. So I don't think we should underestimate the importance of the contributions that public companies can make and their scale. And our capital markets were there for them through all of that. That said, if those investment opportunities are not available to investors to share in that success, it's not going to work here, right? So this country has really been built on that two parts of that balance, that yes, you can grow a business and you can earn a living and you can make a lot of money doing that, but you're sharing it. And that democratization is such a big part of why capitalism has worked here for so long. And frankly, I think that's where we need to figure out what elements are not working quite the way they used to, because I think we're not giving quite the same amount of opportunities to others to share in that success. So when I think about the NYSE and my key priorities, that focus on maintaining that balance for investors to have choice and access to opportunities while still focusing on investor protections is certainly key and core, but then new opportunities. So we're looking at what are the new ways for people to invest and having new ways for companies to go public. We've been very focused on direct listings as an alternative. And I am happy to talk about the pros and cons to the different paths to the public markets, but innovating in the public markets so that more people can participate in that first day. That's been a really significant move, and that democratization access to opportunities is really critical. And also just looking at what are new and innovative technologies out there, and how can we tap into delivering those to investors. And then importantly, as I started with, this community has so much power. So really driving change and leveraging the power of our entire 2,200 listed companies that are here and the breadth of our community to change the world is kind of fun. So we spend time doing that too. And I'm looking forward to talking about some of the ways that we've been working on that.
Great. So I am going to take you up on both of those offers. One, really, I would love to hear a little bit more as you are seeing these different ways of going to market, the pros and cons. Talk to us a little bit about some of the trends that you are seeing in that space.
Yeah, absolutely. If you think about why companies would have why they go public, it's changed. So traditionally, it was all about capital raising. Companies wanted to raise money and they needed to go to the public markets to get access to that money. That was their primary driver. Once they became public, there were other benefits to being public, like having the visibility of being a public company and that credibility that goes along with it, the currency to engage in M&A, the liquidity for their shareholders and their employees, importantly. But those were just sort of benefits that came with being public. The primary driver was raising money. Given how much money is available in the private markets, many companies are waiting to go public to much later. And frankly, that's one of the challenges that I think we do have in our markets today. And when I talk about the differences that, why I think capitalism needs some adjustments, because companies are waiting so much longer, it means investors are missing out on those opportunities. But I'll come back to that in a second. So because they're waiting so much longer, it's actually not about capital raising, right? They can raise capital privately. They're going public as their primary driver for those other reasons, because they've been paying their employees in equity for many years, and their employees want to buy a house. They need to be able to use that money. So liquidity is really a primary driver for many companies going public, or that currency for M&A. All those other reasons that were secondary or tertiary reasons have become their primary goals for going public, and raising capital has been somewhat secondary. Because of that, companies are asking themselves, well, why do I need to go public the way, do an IPO in a traditional format? Because it's not about a public offering that I'm issuing new capital. And so that Spotify was really the first company that came to us and said, this isn't about raising money, but I want to be a public company. I want all those other benefits. Can I just let the market price it? And there were two primary drivers for Spotify. One was democratization. They wanted all of their customers to have the same access to their market debut that all other investors have. And the concept that certain institutional investors would have an allocation the night before and then be able to invest when that wasn't open to everybody, and have more information on a roadshow that wasn't available to all investors that didn't sit well with the CEO. The second part was that pricing, right? So if you see an offering the night before and then it pops 100% the next day, they say, well, that's great. That looks like a great IPO. It's up 100%, unless you're the person that sold it the night before. So that undervaluing in the market was really a concern, that cost of capital. And so we worked for a year and a half on developing a way to solve both of those things. How do we let all investors have a level playing field so that the retail investors would have the same access to new dynamic companies going public? And that was a big driver. And how do we let the market really value companies? And so that's why we developed the direct listing and have been working on it with the SEC to introduce a capital raising as part of that as well, so that all investors have access if companies do want to do an offering. Because that first one really decoupled the concept of raising capital and going public. It just said you don't have to do them at the same time. Now, if you did want to raise capital at the time you're going public, that's why we introduced the direct listing with the capital raise. So if you think about the different paths to public, the traditional IPO is tried and true. You work with banks, and they allows for a roadshow to target investors. Some of the reasons why companies will choose that path is they feel that confidence in meeting with targeted investors and having that base that they want as they go public. And so that's typically why they might choose that path. The direct listing actually does still allow for a roadshow, but it's also is about cost of capital and reducing that first day pop, and democratization, opening it up to others. And then SPACs have also clearly gotten a lot of headlines as an alternative way to go public too. And there, again, it's about control and negotiating with a single counterparty. And the incentive structure, I think, has some work to do. And we're starting to see all three of these different ways of going public become more evolved. And so companies have more choice now, and they can take elements from each one. And I think we're going to end up in a much better place as we're taking the best of each path to public and focusing on protecting investors, but still getting companies into the public markets earlier.
Well, thank you for taking us through that. And we were talking a bit about opening up opportunity, and I want to sort of pivot our focus a bit to the focus of the forum on diversity and inclusion. And with that, you talked about the listed companies and their real desire to make a difference. And certainly, as we think about issues along the lines of board diversity, there's been clear empirical evidence on the impact of diverse boards on company performance, both in the short and long term. And what are the kinds of things that you're seeing in terms of trends with respect to board diversity? And what are some of the key challenges that companies may be facing in this context as well?
So I will say that companies are very focused on this across the board, and we have been working very closely with our listed company community on driving the change, driving changes that we see. And the trends are that as more board members are being added to boards, the diversity profile of new board members is increasing, and so we are starting to see a really quick pace of change. It's taken way too long, and there's still a lot more work to do, but you are seeing that there, on a percentage basis, there are more women and people of color that are being added into boards. And the Alliance for Board Diversity just put out a study showing how that pace has changed so dramatically over the past 10 years. There's still a lot of work to do. Companies are struggling with changing the way they think about how they do things. So most board seats are filled through networks, not through recruiting firms. And if your network is not as diverse as you want your board to be, that's going to be a barrier to being able to diversify the board. And I know that we talked about touching on this, but we're looking for solutions on that front. But those are some of the challenges that companies have, and turning over board members at a pace, and also finding people to add to their board when they have their practice and their tendency, whether it be CEOs or nom-gov chairs or others, is to tap into their own networks. If they're not diverse enough, that's just not going to work. So we need to break down some of those barriers to really advancing change.
And so, a little bit about some of the initiatives that the NYSE has undertaken as you're working with companies to approach this issue of expansion of the network to really help with the desire for board diversity.
So we think about it in three buckets when we think about diversity, both at NYSE and ICE, our the parent company of NYSE. And we think about diversity in one, our own corporate governance. And so if we're not diverse on our board, we're not going to be able to drive the change that we want to see in our own organization. And so we have 42% of our board is women, and 25% people of color. And so we've really focused on making sure our own board is diverse. Second bucket is our employee base, and holding ourselves accountable by publishing our EO1 data, by looking at our hiring techniques, by looking at same thing, if you're hiring through your network and people you've worked with before, and you're already in an industry that's not as diverse as it needs to be, your network is not likely to be as diverse as you want your company to be. So we had to rethink, how do we hire, how do we write job recs? Because if you're outlining specific criteria and experience that you need to have for employees that you're bringing into your organization, and again, that universe is not going to be as diverse as you need it to be, you're at the top of the funnel, you're really impacting your candidate base. So we've rewritten our job recs. We've acknowledged the fact that it's going to take us longer to hire, because when you open a new job opportunity, you get a bunch of resumes in the 24 hours, and it's not the diversity profile of what you're looking to hire. So you have to acknowledge and be intentional that you're willing to wait. We also look at waiting to have a diverse group before we present those candidates to a hiring manager, because if the hiring manager starts interviewing people and they meet somebody they really like, and then they're adding more candidates just to make sure they're getting a diverse group, you're not really giving those candidates that may have taken longer to make it into the stream the same opportunity that earlier candidates have. So we wait until we have a group to present. Another challenge that you have at the employee level that we focus on is when you're an acquisitive company, as you get into M&A and you acquire a company, you may have spent a lot of time making sure you have the diversity profile or advancement that you want to see, and then acquire a company that you now need to kind of work on that again. So you have to constantly be intentional about it. But so the buckets are governance, employees, and then third, our community. So we look at our community. How can we use our platform to drive the change that we want to see? And I'm so excited by the way we've been able to partner with our listed companies to really make a difference in how we're thinking about diversity and how we're approaching it. So 2 years ago, we announced the launch of the NYSE Board Advisory Council. And this goes back to that concept that board seats are filled through referrals and networks. And so we're tapping into the network of the CEOs who are listed on the New York Stock Exchange just to crowdsource, frankly, their diverse candidates for our entire community. So there are 20 CEOs of NYSE listed companies who, as council members, have committed to providing us a list of names of diverse independent directors that they would recommend to sit on corporate boards, and also to be a resource. So if a company is looking to add a new director, not only will we give them a database of names that they can have, and we have roughly 300 candidates that are all sourced from CEOs from our community. Not only will we give them that database, we'll also give them a curated list based on the criteria they've told us at the NYSE that they're looking for. And then third, we'll say, and here's the CEO that put that person into this database. So you can reach out and talk to them and get some color around how you think they might be an asset to your organization. So we've been working with the directors, NomGov chairs, and CEOs on trying to actually come up with solutions to drive the changes that we see on corporate boards. And there are a lot of companies that are really dedicated to seeing a change. And we've seen the progress, right? We've made a lot of progress, and I'll touch on it in a second. But so that solution is one area that we focus on at NYSE NYSE. Second, we're also focused on the data that allows investors to see into what companies are doing. So ICE Data Services collects ESG data across 500 different criteria to provide to investors, to index creators, to others around ESG, so that when investors are looking to make ESG decisions, they actually have the publicly available data in one place in a clean source for companies, so that they can see all of that information. So a big part of that data is around diversity, what companies are doing, what they are, what they've stated they're doing and what they're actually doing. So we'll look at year over year what those results are. And so that you can actually see the change, and companies can actually see how they're being stacked up. And we put all of that together in a way that we can help companies look to make the change that they want to see in their organizations. We think that's really important. If we don't deliver solutions, we're not going to see the change that we want to see.
I love the construct of, again, expanding that network, crowdsourcing the information and crowdsourcing that network. I think that's a really interesting set of analogies. And I wanted to talk a little bit also about the fact that NASDAQ has taken a slightly different approach, where they've really focused on seeking to change listing requirements to require companies to disclose diversity on their boards, or provide an explanation if they don't have directors who self-identify as women or members of an underrepresented minority. Can you tell me a little bit about the considerations that the NYSE took in implementing its approach versus the NASDAQ approach?
Yeah, I do. I think it's really important, because our role is to maximize investor opportunity and investor protections. And so our view is that when we use our listing standards to drive the change that we want to see, we're defining the investable universe, because our listing standards define whether or not you can be a public company. And if we put into our listing standards criteria that are really well intended criteria, the issue is the investors no longer have that choice. We're taking that choice away from them when we're defining what they have access to. So it's critical for investors to demand the change that they want to see, and they are doing it. And that's why you're seeing the pace of change increase so much. But we don't think it's appropriate to use our listing standards because of the role we play as a regulatory organization, but we're not elected. So it is more appropriate for the administration, and I expect we will see the SEC looking at this topic and looking at changes that they might want to see in the public company universe. But for the exchanges who are not elected officials to define what we want to see public companies look like, we're deciding for investors then. And I don't think it's appropriate for Stacey Cunningham or the NYSE to decide what opportunities investors have access to. That said, I'm passionate about diversity. So we're actually doing the work that we need to do to drive the real change that we want to see. So we have stopped short of using our listing standards, but we are actively working and engaged with our companies. And when you see the results, when NYSE listed companies have better diversity stats than NASDAQ listed companies, and we're seeing that change drive. And at this point in time, looking at the Russell 1000, and we can see it in the data that we collect for institutions and others, 99% of NYSE listed companies have a woman on their board, which is what the disclosure requirement is that NASDAQ had put in place, to have one woman. There's 91% have two or more, 83% have 20% or more. That progress is different from where we were just a few years ago. So there's still more work to be done around racial diversity, because a lot of companies don't disclose that data. Only about 40% of the S&P 500, or maybe 42% of the S&P 500 are disclosing that data around racial diversity. So that information can help drive the change that investors want to see. So I expect the SEC to be focused on that.
Is a great segue. So we are starting to see the FCC and the administration and Congress consider issues related to ESG and particularly board diversity. And I think we've seen parallels in other countries as well, such as Germany, where quotas are being advanced. So what policies should Congress and the administration and financial regulators really be thinking about with respect to board diversity? Again, having had the seat that you do, where you get to see sort of really where companies are focused and where there could be real advancements to change.
Yeah, and I think just as important as what policies should we see is also how we present them and how we implement them. So when we implement standards and requirements on companies, especially when they come with risk and liability associated with them, much like the Sarbanes-Oxley requirements that we have and others, if they get implemented in that way, the idea that companies might wait longer to be public because it's hard to comply is a concern. So I think it's really important for the SEC, and I'm encouraged because I expect they will focus on disclosures and transparency so that investors can make informed decisions. But we should not lose sight of the consequences of what restrictions we put on public companies that don't exist on private companies, because companies do have choices. So if they're looking to raise money, they can raise them elsewhere. And investors lose if they don't have access to those opportunities in the private market space. This is a real issue. And I think it's contributing to the wealth divide in this nation. And we don't give it enough attention, because if companies are growing really, really rapidly in the private market space, and then they come out into the public markets as mature companies where their fastest years of growth have already passed, professional investors have access to those opportunities, but the everyday investor does not. And we need to make sure that we're still providing those opportunities that are really going to drive meaningful change to all investors. You look at companies like Salesforce or Amazon that came public and saw the vast growth happen in the public markets. Those are the opportunities that are really going to allow for investors to share in that success. And we need to make sure we're not giving that up. And so by putting so many restrictions on public companies, as I talk to private companies considering going public, they're saying it's going to be so much work to get to that standard. And we're focusing on growing our business right now. So I want to wait until we've done all the really cool things we want to do, and then we'll go public. That's not a good thing for a good outcome for investors. So while I am passionate about investor protections and I want to see the change that we are encouraging, investors need to drive that change by rewarding the companies that are taking the steps that they need to take to advance society, but not by just I'm concerned if we put too many restrictions on even allowing them to be public companies, then we're going to further exacerbate that wealth divide that we're seeing between those opportunities that not all investors will have access to. Did I answer your question? I feel like I think the SEC needs to look at it, but I think we need to be careful.
Thank you. No, I think that was just a really important set of considerations. Really, we're sort of thinking about diversity and inclusion across the spectrum. So thank you for that, Stacey. I really just want to thank you. We're so grateful for you being with us today. Thank you so much for sharing your experience and insights. And thank you to everyone in the audience. We are going to now take another short break and resume with our next session at 11:15 a.m. Pacific time. Thank you again. Take care.
Thanks, Krishna.